Hey, what's up, my friend? So before we get to today's video, okay, some of you have been asking me, hey Rayner, where can I learn more about your trading strategies, right? Your techniques and stuff like that. So what I always say is that, just go down to my website, tradingwithrayner.com. Over here, here's the link, okay? And just scroll down to the bottom, depending what you need. If you want to learn how to write massive trends in the market, go and download this book over here, The Ultimate Trend Following Guide. We cover trend following techniques, right, on how you can actually go on and write bull markets and bear markets. So now, if you are the trader that wants to better time your entries and exits, right, to read the price action, market structure, then this guide will help you. The Ultimate Guide to Price Action Trading. Just click this blue button and I'll send it to your inbox for free. So these two guides are completely free, depending what you need, right? Just download both of them if you want to, right? And you'll get started on how I approach the markets. This is, I would say, the best way, to learn. Okay, so this is just what I want to share with you. Moving on, right now, for this week's video, I want to share with you the 3 best setups that I'm looking at for this month of October. So the first setup that I'm looking at is the dollar against the Sing. Okay, so if you look back at the big picture, the dollar Sing, right, has been pretty much in an uptrend over the last few months, since February, March till right now. It's about coming October, over the last 6 months, 7 months or so. So what I'm seeing here is that this market, okay, we have this resistance coming at the 138 level, and what I like is that there is signs of strength in this market, because notice, right, I actually have this upward trend line over here showing you higher lows over here. So there's a good chance that this market could retest back this area of resistance and possibly, right, maybe even breaking out above the resistance. So now, here's the thing, right, where is a low risk entry to trade this market? So you know that you are long, okay, you want to buy, but where do you buy? So this is where multiple time frame analysis comes into play. You know that this over here is an upward trend line, and near the trend line is where there is potential buying pressure. So this is a good area of value that you want to trade from. So if you look at this and the 4-hour time frame, what I'm seeing is over here, this market has pretty much bounced off the trend line once, twice, 3 times, 4 times, and right now at the 5th time. So right now, if you look at the price action closely, okay, we had a price rejection over here, and right now the market has rallied higher, right? Notice this big bold candles, 1, 2, and 3, showing you signs of strength in the market. And at the same time, right, the sellers are getting weak, right? Notice that the selling pressure, they are not like so aggressive over this previous selling move over here, or like this previous selling move over here. The most recent price action by the sellers is just this small range candles over here, telling you that the selling pressure has weakened, right, and they can't seem to push price any lower. So what I plan to do is to look to buy, to go long. So if the price can break above this highs, I want to go long. Okay, and then what I'll do is, okay, just share with you, right, if the price can break above this highs, I would look to go long and have my stop loss, right, 1 ATR below this low. So the thought process is this, right, is number 1, we are trading with the trend. It's an uptrend, right? You saw earlier on the daily time frame, it's an uptrend. Number 2, we are trading from this area of value, which is the trend line, which I just highlighted, that you can see over here, the trend line. Okay, and number 3, the entry trigger, let's call it the ET, right? The entry trigger, not extraterrestrial, ET, entry trigger, is that we saw that this market has a weak pullback on this small range candle. So if the market can break above this highs, this is a trigger to go long, the break above the highs, right? So this is my setup that I'm looking at for the dollar Sing. Okay, so this is the core idea behind this setup on the dollar Sing, and how I would manage the trade, right, would go something like this. I would look at the daily time frame, and I would expect the price to reverse back quickly towards the upside. So what I want to do after which is that if the market gets me long, if I have a valid entry trigger and I'm in the trade, and if the market breaks out higher, right, let's say it breaks out higher, and higher, I want to be trailing my stop loss, right, on the previous day low. Okay, so if the market breaks and close below the previous day low, then only then will I exit the trade, right? If it doesn't, right, say for example it comes up higher, then it'll consolidate a little bit near the highs but didn't take out the lows and then break out of the resistance, I could possibly still in the trade. So that would be the ideal situation where, I hit a home run, but usually it doesn't really happen often. So this is how I'm going to manage my trade, right? From pretty much the start to finish. The setup that I talk about, the entries, the stop loss, and the trade management. Okay, so this is for dollar Sing, right? I would say it's a market that's worth watching. Another market that I want to share with you, it's New Zealand yen. Okay, so if I just scroll up a little bit, New Zealand yen. Okay, so one thing to note, right, is you can see that this market, again, since last year, July, has been in this downward trend channel for more than a year. And you can see that the market, right, pretty much, has been respecting the channel for quite a while, right? Here, bounce, here, right? Here almost, and here right now is at this area of value again. Okay, so before we talk about this short setup, I want to share with you where is the worst possible time to trade towards the downside. Okay, if you notice that the market is in this downward trend channel, right, the worst time to go short is when the market is near the lows of the trend channel. Because think about this, right, this is where the market has proven, right, that it tends to find buyers, right? Why you want to be shorting, right, at the lows of this trend channel. So if you ask me, the best risk to reward, right, in trading this type of market condition is from an area of value near the highs of this trend channel, which is somewhere about here. Okay, so a couple of ways that you can look to trade this, right? Again, I would go down to the 4-hour time frame and look for a valid entry trigger. So number one, right, I would say the more aggressive approach is that if the price can come up to this high, do a false break, right, I would look to get short over here, right? Notice that if this is the high over here, and if the high holds, right, and the market does reverse down lower, you can see that this is possibly one of the best places to go short near the highs of the upper trendline channel and the swing high over here. So that's the first possible possibility. The second possibility is the market, right, comes down lower, right, forming somewhat of a descending triangle. Okay, so you're gonna see a build up form near the lows. So if the market can break down below this lows of this swing low, you can then reference this swing high as your stop loss, right? And in anticipation that again the market could continue lower. Okay, so one thing to bear in mind is that again, right, you're trading from an area of value on this higher time frame. So over here, right, it's there's a favorable risk to reward if you're looking to short at this area rather than near the lows of this trend channel where the risk to reward really isn't in your favor. Okay, so this is New Zealand yen, another market that's worth watching. And the last one that I want to share with you is the 30-year bond. Okay, so you can see that over here, this one over here, right, I would say this is somewhat, it can really fall between a counter trend trade or trend following trade. It really depends how you look at it. So the first thing to look at it is that this market is at this area of value, this long-term key support area, and it pretty much got rejected once and twice. So if you look at a 4-hour time frame, right, you can see that the sellers right now are in control. So what I was actually looking at previously, like, is that previously where the market was still something like this, right, I was thinking that maybe right now this price is at this area of resistance, it could actually break out higher, break above this highs, right, where I could go long. Similar to the dollar Sing setup that I shared with you. I want to see weakness on the pullback, small range candles. But in this case, right, it didn't happen. Notice that the range of the candles here are very large, so telling you that the sellers are still in control. So this kind of invalidate the long setup that I'm looking at, unless the price can go back towards the highs, consolidate, showing small range candles before breaking out. Then hey, that might be a trade setup that I would want to take. But till that happens, right, I am going to look at the daily time frame and then ask myself, right, where do I want to trade this? So at this point of time, right, it could, number one, again, still reverse up higher, or number two, this could be a bear flag that's forming, right, a potential bear flag that's forming, right, something like this, right, a flag pattern. So if the market can come down, consolidate, right, and break down, this will be a trend continuation setup, right, where the market has broke out of this area of support, consolidate tightly, and then break down. And again, stop loss can just go 1 ATR above the highs. So this is again a 30-year treasury bond trade that you can look at. Okay, in fact, all the other bond markets, the 10-year, the 5-year, they all look very similar. So in terms of relative strength, right, the 5-year seems to be the weaker one at this point in time. It's a much further away from this area of support, right? You can see that it has fell more compared to this 30-year bond, where it's still hovering near this area of support. So depending on the trade setup that occurs, right? If it's going to break out higher, I would choose to trade the T-bond futures since it's a stronger market among the other bond markets. If I want to short, I would go with the 5-year since it's the weakest market among the 3 bond markets that I've just shared with you. All right, so these are the 3 core trading setups that I would say it's worth paying attention to for this coming week. So with that said, right, I've come towards the end of this video, right? If you have any feedback, any questions, let me know in the comment section below. And if you have enjoyed this video, right, hit the thumbs up button, right? Subscribe to my YouTube channel so you can get such videos and analysis, right, on a regular basis. So with that said, right, I wish you good luck and good trading. I'll talk to you soon.